Our next guest, Julie, is the former chief accountant at the SEC. He says today's decision out of FASB will encourage banks to lie about their assets. He's Lynn Turner, senior advisor for forensic accounting firm LECG. He comes to us from Denver this morning. Lynn, very glad you could join us. The cat is out of the bag. The FASB has decided to relax these rules for companies, but principally for the banks, allowing them significant judgment when it comes to valuing these so-called inactive assets. Now that it's happened, what does it mean?
You know, Eric, I don't think it means really a whole lot. Tomorrow morning, we're all going to get up. The banks aren't going to give back any of the money. The banks are probably still going to need more money. And the bottom line is the banks will still have all the bad loans on their books. And until Congress and the regulators are able to work those bad loans off the books of the banks, things aren't going to turn around. The economy isn't all of a sudden going to turn around. So this really doesn't fix anything. All it really does is allow the banks to inflate their profits and tell people they're really doing better than they really are.
Okay, well, let's dig into that point that you just made a little bit further. Why is it that investors seem encouraged by this decision when it may just end up making the banks look more like GE?
Well, I think you've really got a split amongst some of the investors here. I think investors who really dig into these numbers and understand that this could lead to almost Chinese water torture for the markets where the losses are just dripped in year after year, much like they were in Japan during the 1990s when Japan was not able to turn around its economy. I think you got a group of analysts that are concerned about that. Then you've got a group of analysts that probably aren't quite as astute, aren't doing their homework. Those are the type of people that ran this market up to 14,000 in the first place and overinflated it. So I think you probably have to break that down between those two groups. At the end of the day, what's really going to count is, in the long run, what do the banks make? In the long run, what type of cash are they generating? And as we all know now, right now they aren't. In fact, they're coming to us as taxpayers and saying they need our money to operate.
Is it fair to compare this situation to what we've seen happen with GE? GE only has to use fair value treatment for something like 2% of its assets. Is this, as I sort of implied, making banks more like GE in the sense that they become less transparent, harder for investors to evaluate?
Yes, I think you're absolutely dead on target with that comment, Eric. It does make it much more difficult. People have to ferret through the numbers. As a result, they ask for more of a risk premium when they invest. It drives the cost of capital up, the prices of stocks. In the long run, just aren't sustainable then. And it does create very opaque financials, very difficult analysis, and doesn't help investors out at all.
Lynn, what do you say to all the people who said we needed a change, that something had to give here, that even if it's only temporary relief, which is what we heard from House Majority Leader Steny Hoyer this morning, it was necessary to give the banks some breathing space?
The problem is, again, we'll all wake up tomorrow morning and the banks aren't going to give back any cash. They're still going to need more cash. It really doesn't fix anything. It doesn't change the economics of the bank's balance sheets. They still have the bad loans. What it does is allow people to create a facade and feel good and look good, but in the long run, that doesn't solve the problem. The real problem here is the banks made tons, millions upon millions. I mean, they're called liar loans. They're called ninja loans. The fact that the regulators allowed these banks to make these loans, that Congress did absolutely no oversight. What's really transpiring here is that the banking industry has gone into Congress, to people like Hoyer, Barney Frank, Paul Kanjorski, gave them bag loads of money to do their hitman job on the FASB. And if anyone thinks that is what's going to fix this economy, then they're sorely mistaken. It's only when we're going to get these loans off and get people back to work that we're going to fix the economy.
Lynn, one thing I want to delve into a bit, the politics of this decision. You yourself are a former public official. You were the chief accountant at the SEC. Is there something wrong with the FASB bowing to political pressure? Because that certainly seems to be the case here.
Yeah, what you want to have the markets really work effectively and work the best for the average American investor is a market where they can get fully informed, get good information. When the politicians get involved, and certainly I saw it while at the SEC. Often they came in and tried to break our arm to get us to do something for a constituent who was paying them money. But when you take that transparency away from the market and take information away from them that people need to make informed decisions, the markets just don't work in a fair and orderly fashion. And that is very bad, and that's exactly what we're seeing in this particular scenario with respect to the banks.
Well, what's more important, though, markets working in a fair and orderly fashion or some kind of fix for the economy? Because people point out that in the early 1990s, banks were in trouble, perhaps not in as deep trouble as they are now, and they survived, and we didn't have mark-to-market accounting back then.
Actually, that's not exactly true. Back then, and I was actually at the commission during the S&L crisis, when Richard Breeden came in as chairman of the SEC, he did force the banks to take these marks and, in fact, did enforcement actions against two of the largest banks in the U.S. who refused to do so. And by doing so, though, he got them to tell the regulators, management, the boards, exactly what the true numbers were so they could start managing their problem. You only really manage what you can measure. And so if the banks aren't appropriately measuring what's going on inside, it's very difficult to manage them. That's what we're seeing today, and that's what this FASB rule change is going to permit. Less management, less accountability, and certainly less informed investors, so they're going to be kind of flying in the dark, if you will, if they don't do a lot of homework before they make investment decisions. A really, really bad move for the markets.